My guest today is Terri Vaughan. Terri is the Rob B. Kelly Visiting Distinguished Professor of Insurance and Actuarial Science at Drake University in Des Moines, Iowa. During the financial crisis, Terri was the CEO of the National Association of Insurance Commissioners, a support organization for state insurance regulators. Prior to joining the NAIC, Terri spent time in both academia and in regulation as Iowa Insurance Commissioner and NAIC President. Terri, welcome to the show.
Thank you, David.
So, you wrote a paper during the financial crisis promoting the efficacy of state regulation of insurers as distinct from federal regulation of banks, let's say, and the proposed federal regulation of insurers, or implicit proposal for that. And I studied this paper as an actuarial student and found the arguments absolutely captivating. You write elsewhere of the concept of market discipline as another regulatory force, but as I read your work and think about insurance regulation, I'm always struck at the debate between state and federal regulation feels kind of similar to me to that of regulation at all versus market discipline as it exists in insurance. Boosters of state regulation are anti-centralization, emphasize diversity of markets and local knowledge. These are both libertarian, kind of Hayekian ideas, and only in a very insurance kind of way try to talk their competitors into making better decisions, which is something insurance companies do all the time too. Then what do you think about this comparison between state regulation and market discipline?
I think it's an interesting parallel, and I hadn't really thought about it, but your pointing to libertarian Hayekian ideals is interesting because I do think that there is some grounding there that's similar. In theory, though, you can have a regulatory system and a market structure that promotes market discipline at either the federal or the state level. So it doesn't really the place at which the regulation is happening shouldn't have an impact. It's all about having a structure in which the financial institutions, whether it be banks or insurance companies, are incented to engage in the right risk-taking behaviors. And you do that by making sure that their counterparties, their depositors, their policyholders, the people that are lending them money, their creditors, are have to bear the losses. And if they have to bear the losses, then they're going to give an incentive to the companies to take the right kinds of risks. In banking, historically, you go way back in banking, there was market discipline, and banks policed themselves. I'm reading a really good book right now called Borrowed Time.
Okay.
And it is, the subtitle is 2 Centuries of Boom, Busts, and Bailouts at Citi.
Okay.
And it traces the history of Citi from the 1800s through the multiple bailouts, multiple crises and bailouts that it had. And then it draws the parallel between these bailouts and the increasing ties between Citi and Washington and the federal government. This kind of back and forth, the people who are leaving the bank to go to Washington or leaving Washington to come to the bank. So it's perhaps not surprising that the bank increased its connections to Washington over time as that became more important. So in theory, you can have a structure that promotes market discipline at either the federal or state level. And there was a lot of discussion in Washington, even in the 1980s, about market discipline and the fact that we don't have enough market discipline on banks. The question that I've always asked myself is, why is it that seemed to have happened more in banking than it did in insurance? These bailouts, these serial bailouts have happened in banking, not so much in insurance. And why is that?
Why is that?
Well, it's a really good question. And
it's one of my questions, or at least one of the things I'm definitely interested in learning more about.
I think it has something to do, certainly, with the resources at the federal government. The states don't have the resources to do these kind of bailouts. I think it probably has something to do with the culture, too. $1 million in Washington has a very different feel than $1 million in the state of Iowa. I mean, that just so, and I think it may have something to do with this kind of relationship between the big banks in Washington. That I can't say for sure, but I think
do you think that's a corrupt thing, though? Because I feel like one of the things that's I think maybe underappreciated or maybe maybe not acknowledged, maybe doesn't exist. I don't know, but I feel like whenever I encounter people who are, say, bureaucrats or regulators, man, they got their heart's in the right place.
Absolutely.
They want to do the right thing.
Absolutely.
Right? And so if you have these two facts, on the one hand you have people who are trying to do the right thing, on the other hand you have some pretty perverse outcomes, right? Kicking the can down the road, all that kind of thing. how do you reconcile them? Here's my thought. My thought is it's actually an information problem. So these people, you think lobbyists, you have the revolving door, Wall Street, and then I think that the image that conjures up is one of just absolute corruption, like you're in Afghanistan or something, right? But I think it's actually more about a mindset, which, as you mentioned a second ago, that winds up. I don't want to use too many disease metaphors here, but infecting or at least taking over, and they believe what they kind of are trained to believe or selected for believing in the private market, that you do need bailouts, for example. And so they don't have that independence or perspective on the problem because the information they're getting is all from these people who are very biased.
I think you hit your nail on the head. It's an information problem. And I've thought this for a long time. I've talked a lot back in the days when I was a regulator and I was CEO of the NAIC. I would talk a lot about the concept of regulatory capture. Mm-hmm. And I never meant regulatory capture in the sense that the regulators are patsies for the industry.
Yep.
It is that the regulators spend a lot more time listening to the regulated entities
Yep.
than they do to others.
Yep.
And the bigger the portfolio of things that you're dealing with, the more time you're spending with that regulated industry. Mm-hmm. I remember when I first got to Washington, the first year I was there, sitting in on a meeting, and it was a group of folks from industry, and the subject of discussion was who knew someone who could get him a meeting with Tim Geithner.
Right, okay.
And right then I thought, that's the problem.
Huh.
The problem is who has access to the policymakers in Washington.
Yeah.
It's the people who know people. And that creates an information flow that makes it really hard to think in a way. I think it frames your, how you look at the world. Mm-hmm. And they are absolutely well-meaning people, but you have to work hard to make sure that you're hearing from that other side and you're thinking about that other side when industry has such an incentive to get to the regulator and the policymakers. So they're putting a lot of effort into it.
And, even the meta problem is very well known, right? I mean, I'm familiar with the book by Mansur Olson, The Logic of Collective Action, where this whole idea here of like small, highly motivated groups can get a lot done.
Yes.
Because they're so highly motivated.
Right.
You have concentrated benefit and diffuse cost.
Exactly.
Right? So let's just take a penny from everybody and give it to me.
Yeah.
Boy, that'd be nice for me. I'm going to advocate for that. And people losing a penny, it's like, it's a penny.
Exactly. Yeah, there are those things that industry cares about. They're going to put a lot of effort into it, and they're going to put the resources into it because there's a payoff for it.
Yeah,
and that's a constant challenge when you're a regulator.
So let's actually back up a little bit. Talk about the NAIC. So you spent time as a state regulator in Des Moines, and then you joined this thing called the NAIC, right? So what is the NAIC, and why did you join it?
So let me back up for a minute because
Sure.
I was a professor at Drake before I was an insurance regulator.
Okay.
And at the time, I actually went to NAIC meetings as a professor. So I knew the NAIC as an attendee for probably 5-6 years before I became commissioner.
And what were you teaching at Drake? Like what got them?
Insurance and actuarial science.
And was it common for professors of insurance and actuarial science to attend NAIC meetings?
No,
okay.
It was not.
So you were an exception here.
I was an exception.
Where did that?
And the reason was because I was the director of what was called the Insurance Center at Drake University at the time.
Okay.
And we did consulting with state regulators.
Okay.
We helped them with continuing education agent licensing exams. And at one point early in my tenure at Drake, I was asked by some of the financial regulators from New York, Illinois, particularly Illinois, Jim Schott of Illinois, approached me about developing an education program for regulators in honor of Ken Smith, who was a very prominent regulator in Illinois who had passed away. So we developed this, and it was a 2-week on campus. Regulators from around the country would come in, spend 2 weeks on campus at Drake working through financial regulation issues. And so through that process, I got to know a lot of regulators. So I knew a fair amount before I became insurance commissioner.
So worth pausing for a second and observing, because you knew them, right?
Yes, I knew some of them. I knew some of them.
And one of the things that occurred to me, and I'm sorry to interrupt you, but I just really want to get this point because I think it's really interesting. As you were describing, the problem in Washington and anyway with access to power, call it controlling the agenda, that to me is actually call it a somewhat pernicious example of a model which applies everywhere, which is, I think about my job in sales, right? It's just trying to get access to people.
Exactly, right.
It's a networking job. I mean, everything in life is networking, right? I mean, if you want to if you want to learn more, you have to network.
Right.
If you want to, no matter what your goal is, the answer is usually communicating with people somewhere.
Right.
And here you have a situation where your development in your career path was by the people you know.
Yeah. Right.
So, and I interrupted, so please do continue.
Right.
Observer at the NAIC.
Yeah. So, and then when I became insurance commissioner, your question was about the NAIC, right? The structure of the NAIC. When I became insurance commissioner, then I fairly quickly became actively involved in the NAIC.
Yeah.
And the NAIC is, it's a really interesting organization it's governed by the commissioners, the 50-some insurance commissioners, 50 states, District of Columbia, and territories. A subset of them, elected by their peers, form the board of directors, essentially, of the organization, and then they hire a CEO to run the organization.
Right.
It's a sizable, it's 450, probably more now. When I was there, it was about 450. I'm sure it's more now. People in Kansas City, New York, and Washington, D.C. So it's a pretty good organization. But at the end of the day, it is answerable to the regulators.
And they probably pay for it, I guess? The
regulators actually pay a small amount of the budget of the NAIC.
Okay.
The majority of the budget of the NAIC comes from products and services that the NAIC sells, from fees that insurance companies have to file when they file their financial statements with the NAIC. So state laws say you have to file your statements with the NAIC, and NAIC says, yeah, but you have to pay us to do it, and so they get some money from that.
Yeah.
But so it's the structure. The NAIC has probably 150, 200 different committees and working groups.
Oh my goodness!
That are dealing with different issues.
Wow!
And those are all staffed by the regulators from the states, and NAIC staff then support the regulators in coming to policy conclusions or doing the work. So it's a highly engaged. It's a forum where regulators from the different states spend a lot of time, huge amount of time, working together to think about issues in a coordinated way. And so what was the rest of your question?
Yeah, what I'm interested in is how it's structured, and you got to that. What does it do? It coordinates regulatory action amongst different states. Yeah. And through these committees, that's the way it does it, I guess.
Well, yeah. So it, if you go back, it was created in 1871 when Paul versus Virginia said insurance is not interstate commerce. Yeah. 1869. 1871, the states say, oh, okay, it's not interstate commerce, but we've got this national industry. We better figure out how we're going to work together to regulate it. And so they formed this organization. I think it's the longest standing organization of state officials in the country. And they started to work on ways to make it easier for companies to do business in a cross-border way. You have to have some consistency in how you're doing things for companies to be able to do that. Because remember, any company that wants to do business in Nebraska has to be licensed in Nebraska, wherever they come from. And so how can you, and they have to file financial statements. So how can you make this process more seamless? And, one of the ways you do that is by having a certain amount of consistency in the filings that have to be done, centralized filing with the NAIC through the database, sharing information. So 40%, back when I was CEO, 40% of the budget of the NAIC was information services, information technology. They have a lot of databases. They have a lot of things that the states can sign on to communicate with each other confidentially. There's a lot of information sharing that goes through these NAIC
which is 100% of the revenue, or 90-something% of the revenue is associated with those services. So that would make some sense, I guess. Yeah. What's the rest of the NAIC's budget? What's that taken up?
Well, they get fees from. There's a system for electronic rate and form filing. Companies and they fees from filings on that. Fees from National Insurance Producer Registry, which is a national agent broker licensing
But on the cost side, in addition to providing the information services, is it travel and communication costs? I mean, what other on the expense side of the budget?
There's a lot in travel and
right. That's what it will be then.
Yeah,
I mean, it's a coordinating function.
It's staff
to
support. It's the information technology. It's travel and supporting the commissioners in travel that is, has national relevance. So they provide some support for the commissioners or their staff to go to NAIC meetings. We had groups of commissioners and staff that participate in international issues or in Washington, and so supporting the travel. That state budgets are tough, really tough.
Yeah.
And they're not built for a regulator at the state level to be active internationally.
Yeah.
So the NAIC supports that.
And so in some ways the NAIC, its very existence is a refutation of state regulation being the right seat of regulation, because if the first thing that, or not the first thing, but an early thing that the states do once they're given the authority or at least they're told now you have to regulate insurance companies, is start banding together and they call it federalize, right? To use kind of the verb there. Why not go to the federal government then? You can sort of, we'll touch on certainly a topic we're going to talk about at some length, but you can kind of see where the thought comes from. Saying, well, if you're coordinating, then maybe we should just give this to the feds, because then there's already a coordinating body for this kind of stuff.
Right. Then why not? Yeah. Right. Yeah, I understand that, and it is something that I found confusion about the NAIC everywhere I went in Washington.
Yeah. They probably thought it was a federal agency.
Yeah, there was some of that. But you have to remember the NAIC is not a regulatory agency. The NAIC doesn't have any regulatory authority. None.
Right. Yeah.
And the only regulatory authority is housed in the states.
Yep.
And so this is a peer-to-peer pressure, a peer-to-peer system. And what creates the pressure on the states to have effective regulation is not some, top-down, this is what you have to do. It's the other states calling into account a fellow state. And so a lot of the structures of the NAIC are there to make sure that the other states have the information that they need. So
level the playing field a bit.
So they can say to this other state,
don't push me around.
Don't push me around. There's an organization, FOG, Financial Analysis Working Group, which is one of the committees, working groups of the NAIC, where NAIC staff and regulators will comb through financial statements of these nationally significant companies, and if they see one that looks questionable, they will take it to a committee of regulators, and those regulators will say to the domestic regulator, the state where that company is domiciled and primarily responsible for regulating it, come on in and talk to us about this. Now, you don't like getting one of those letters, and I can tell you don't like getting it. And there's a little bit of a, why am I having to go? But the fact that you then have to go and answer questions to your fellow regulators creates a certain discipline in how you approach things that I think is really healthy.
And it's kind of previewing the whole SIFI idea, right? That nationally significant insurance. I mean, the language is even similar to the significant financial institutions following the Dodd-Frank Act. I mean, there are a lot of parallels, isn't there, between the banking and insurance regulation? You have this extra layer in insurance of the states. So maybe we can talk about what are the arguments kind of for and against state regulation. We talk a bit about, obviously, there's a coordinating function that's necessary, and so there's a like I said before, there's already a coordinating force in our society, that being the federal government. Why state regulation?
Yeah, I don't know that I call the federal government a coordinating force. I mean, I find
Congress kind of acts in a similar manner.
Congress does.
To call the NAIC for that matter.
Yeah. There's a lot of work that goes into complying with federal regulations. We saw that when I was commissioner in the health insurance area. There's just a lot of effort that often you wondered, is this really worth what we're doing here? What is this doing for our market and our consumers? The traditional arguments that you will hear about state regulation are the laboratory of the states. That's the big one.
Sure.
States can experiment with different things.
Yep.
Diversity of markets. We need to be able to respond to local markets. I think one of the biggest strengths of state regulation is the diversity of thought. The fact that you don't, and this is something I think that as the NAIC becomes a bigger and bigger force in regulation, the states have to guard. They have to really be focused on making sure that they maintain that diversity of thought. When I was a regulator, and it's still the case, New York would think about things differently than Illinois. And that would cause you to go to a meeting and really engage in a very deep conversation about how should we look at this issue.
These are two different perspectives. What's right about each one?
And it was thought-provoking. Constructive. I think that is a very powerful feature because it's not a, kind of people at the top making the decision and sending it down. It's a very diverse, way of looking at things, and then you have to figure out how do we pull these two together. I think that's one. I think the other big advantage of state versus federal regulation is leveling the playing field in the industry. And this goes back to the conversation we had earlier about who gets access in Washington. There's so much responsibility in Washington. There's so much power in Washington. Who gets the access? And the access are the ones who know the policymakers on a personal level. They maybe their kids went to the same schools and they go to the same country clubs or whatever. It's it is much tougher for a mid-sized company in Des Moines, Iowa, to have the kind of access that, pick a company, Travelers has. So, but at the state level, you can kind of moderate that.
And one of the I think striking features about the insurance business over the last X number of years, call it 20, 30, whatever it is consolidation. And so but at the same time, what's incredible about the insurance industry is actually how many insurance companies there are out there. Compare that to, any other industry you can think of. Manufacturers, like smartphone makers, there's like 3 in the world for that matter, right? And yet you have these literally hundreds and hundreds of insurance companies all around the United States. What is going on there?
I don't know, except they compete and they thrive. Some of them are in very niche kinds of places and businesses, and somebody focuses on jewelers and somebody focuses on pharmacists, and they do well. I don't know. So my father was a professor of insurance way back when. And
family business.
It was family business, and we had a professor from Japan who visited. Probably I was in high school, maybe early college, but I remember this professor from Japan came over to the United States. He was an insurance risk management professor, spent a year in the United States at the University of Iowa, and he said to my dad, "You have too many insurance companies." So it is true that we have more.
Some tiny ones.
I don't.
And every other business, they would get extinguished. Right, the light would go out because they would get compete. If you're in any other business I can think of, the power, the brand recognition, the call economies of scale, whatever it is, and I think of the forces that are pushing back against that. I think is this idea of relationships and locality.
Right. I think so.
Local insurance company, the local agent, and people are saying, I don't care if Travelers is cheaper. I don't care. I'm going to deal with this guy because I know him. Right?
I think there's probably some of that, but I think also, don't underestimate the being an expert in some area, focusing, given what you're doing in regulation. In insurance, taking this risk, which is constantly changing. That being an expert in that particular line of business or industry is probably useful.
I think that generally it's easy to overlook or underestimate the diversity of insurance. And then maybe we're saying kind of a similar thing there, where actually you go back to this Paul versus Virginia, the Supreme Court case of this guy who was selling an insurance policy. He's from New York, sold an insurance policy. Samuel Paul was his name, in Virginia. And the question was whether it was the New York regulator or the Virginia regulator. It was like, for insurance is a contract delivered locally was the quote. And so after that, now you have the NAIC, and so you have this tension, right? So is it local? Is it national? It's both. It's hard to tell.
It's both.
And
Yeah.
so you have this institution,
Yeah.
both these institutions of state regulation and federal
Yeah.
regulation.
Yeah. Yeah.
I'd like to.
Can I just?
Yeah, go ahead.
back
Yeah,
up?
go for it.
Because when back in the days when I was insurance commissioner, and we were trying to modernize our system of regulation, we had George Nichols, I think, was the president of the NAIC when we did. It was called the Statement of Intent. There were all these things we were going to do.
Okay.
But one of the things we struggled with as we were coming up with this statement is the fact that the industry is very diverse, that there are different lines of insurance and they have different characteristics, and some are more national than others. And we used to differentiate between, for example, auto or homeowners versus life insurance. You know, life insurance, it's interest rates, it's mortality, it's much more dealing with kind of large national and international forces. And so how could we maintain this kind of local, on the property casualty side, recognize that there were more local influences there, but create a structure on the life insurance side that allowed companies were complaining at the time, we got to get a product approved in all 50 states, and every state is making their own little tweak to it, and it's very expensive, and that's how we came up with what's called the Interstate Compact now, which is company can file their product with the Interstate Compact, get it approved, and it's automatically approved in all of the compact states.
Right. And that doesn't happen in any property and casualty.
No.
Right.
No, it doesn't.
Right.
Now, I think there is an argument to make that there may be some areas of property casualty where that makes sense.
Yeah.
More likely in the commercial lines area.
Yeah, sure. Excess surplus kind of, I mean, that's where it would go now eventually, right? That's what it winds up doing.
Right.
Maybe.
Right. Yeah.
Your use of the word compact is an interesting choice, and obviously that's the term for the structure there. But that reminded me that I think, if I got this right, that compact was actually used for what used to be called the rating organizations that eventually became ISO. I think that those were local state-based
I think they
organizations.
were called compacts.
Yeah, and that was and I think that those were the trigger for undoing state regulation, was actually because their figures they were encouraging collusion amongst these local insurance providers. So, for example, this kind of comes back to what is the structure of regulation back in kind of history, where my mental kind of model on that, which was it was basically all rigged. They set the prices. Everybody has to use the same price. All the insurance companies, and let's say, and this was Georgia, I think, was this case. And if you want to come in as an insurance company, you charge these prices, and basically you're not allowed in, so don't bother trying. And the agents, in some way, controlled this, and it was this environment that was heavily locked down, and that itself was a reaction. So there's no price competition, but that itself was a reaction to actually insolvencies before that, where insurance companies, they cut their rates too deeply, and then they're not charging for enough, and they go bust. It explodes. It's a spectacular thing, and all these policyholders are eating it. So that's a problem too, right? So you solve one problem, saying, okay, fixing prices, everybody's going to make money. Right. Which is not usually what you think regulators are going to try and do, is help the companies. Weird thing about insurance. Right. And then it's like, whoops, too far. Yeah. And then they unwound the price regulation, and that created, the compacts go away. And then,
The Southeastern Underwriters Association case, which is the case you're talking about, is a really interesting one if you go back and look at it, because it was, you are correct, that this idea of these rating bureaus or compacts were instituted following a series of insurance company failures in the early 1900s. And so they said, well, we better do something about this, and we're going to make the companies all put their data together so they have better data, and we're going to have these entities then establish the rates. And then over time, the entities became arguably very uncompetitive, anti-competitive.
Yes.
They had things like, if you're not a member of this rating bureau, if you're a member of this rating bureau, you can't do reinsurance with any company who is not a member, who does reinsurance with those. And so they were really kind of closing off the market. And my recollection is that one of the attorneys general, maybe Missouri, was trying to go after this.
Yeah.
And they were getting stymied because they were so politically powerful. Yeah. So he actually went to the federal government and said, would you please help me? Yeah. And then the federal government took it on. I think that's right. I think that there is this challenge and when McCarran Ferguson then passed, they have a line in there that says, "But in no event will we allow coercion, intimidation, and something else, a boycott, coercion, and intimidation," and that is directly aimed at what was going on in Southeastern Underwriters Association. So there is this balance between making sure that companies have the necessary information and data that they need. And that
their heart's in the right
certain,
place too.
Yeah, and that requires a certain amount of the ability to come together, but then not collusion, not price fixing.
I actually want to go back a step and then we'll go forward just to make it crystal clear, because this is not something that you necessarily think about very much in our era of highly, protected individuals financially, right? You think we have all this, we have deposit insurance, we have all this guarantee funds, and we're not used to thinking about this particular problem, and this problem being bank runs, banks insolvencies, and insurance insolvencies. So what happens, before we had any guarantee funds, back in the 1800s, if your insurance company went bust, that means that you walked in, you bought a policy, and then your house burns down, and you go to the insurance company and say, "My house burned down, I need to submit a claim." They're saying, "Sorry, we're out of business."
Right.
And you're like, "Oh, what do you mean you're out of business?" Like, you don't get any money for that. Right. Your house is gone. You thought you had insurance. Actually, you didn't, because our company's insolvent.
Right.
And then so now you have a highly motivated voter who's going to go to their politician and say, "Don't make that happen again."
Right.
And then now you have, that's where it comes from. All which is an understandable urge.
Right.
And now you have the collusion, which is created, and kind of the pendulum kind of swinging back and forth.
Right.
And
what's interesting is how this issue of rate regulation evolved over time. Because in the beginning, rate regulation was about making sure that companies didn't engage in destructive competition.
Yes.
Destructive competition.
Rates were too
charging
low.
too less.
Yeah.
Now,
too consumer friendly.
Right. Now we are in a world where rate regulation is viewed as, let's make sure that those companies aren't gouging consumers.
Yeah.
And it's just the direct opposite of where it started.
Yeah. Do regulators think about the too much competition now, or is that not a problem? Should they? Is that balance wrong, do you think, or?
Oh, absolutely.
You think it's too far to that direction?
They think about that.
About solvency.
About solvency a lot. I mean, that's the number one thing that the regulators think about is solvency.
But not with respect to rate regulation. They don't. That doesn't kind of.
No, they do actually. The mandate is that in most states rates have to be reasonable, not excessive, not inadequate, not unfairly discriminatory. That's the statute. That's the language of the statute in most states. So the not inadequate, they care about the rates being high enough. It's difficult for a regulator to say to a company, "I think your rates are too low. You need to raise them." I'm not saying it hasn't ever happened, but that's a more challenging thing for a regulator. But what regulators can do, and this is what they do, is they watch the company and they watch the company's financial results. And ideally, at the first hint that there is a problem in the financial results, which low rates should manifest themselves in their financial results, if they catch it quickly enough, then they take the company over and they can force the company to raise its rates and so forth.
And so I guess the mechanism for solvency regulation is not price regulation anymore. Now it's these other things that they monitor.
I think that's I think it tends to be more solvency regulation. Solvency regulation.
Yeah, actually looking at the operations of a company, looking at. So let's actually turn to this thing called the Dingell reports.
Yeah.
So there's a senator in the 90s from Michigan, John Dingell, produced two reports, which I learned about by reading some of your papers and your materials, and I hadn't heard of this before, and it was really interesting. And so the first one was called Failed Promises. I think it was 92 or something. And the second one was called Wishful Thinking. So pretty provocative titles. And I'll give you my kind of impression of what they kind of got at, and you let me know what it felt like at the time, and what you think of it. So Failed Promises, this report was published following an extraordinary dislocation in the 1980s in the insurance business, where there's been subject of a few other episodes of this podcast where we're talking about that period in time, and it was just incredible liability crisis, people call it, companies going out of business all over the place. And so obviously that hits people's radar screens because costing guarantee funds a lot of money. Maybe some policyholders are getting frozen out and not being able to get their claims paid. And so comes the attention of the Senate. Senate commissions this report, and the substance of the report was saying regulators didn't do enough. They made promises and they failed to keep them. And there's a problem here, and one of his solutions was this needs to be a federally regulated industry because we'll do it better.
Yeah.
And then I'll skip to the second one, and you can get your reaction to these. Wishful thinking was more of a commentary on the process of regulation, saying regulators tend to monitor more or less what's going on now, but they don't actually look at the underlying mechanisms and kind of hope it's going to work better by putting some wallpaper solutions kind of up over top of things and not actually achieving any change in the companies. How am I doing with my understanding of these reports?
Yeah, I think reasonably close. Yeah, they were pretty critical of state regulation. I think when you look back at it, this was a time of dislocation not in the insurance sector, but in the banking sector too.
Yes.
There were, the savings and loan crisis. There were a lot of commercial banks
all over
that
the place.
failed. The FDIC was, massive outpouring of funds from the FDIC. So I think it would have been astonishing had there not been some failures in the insurance industry.
Yeah.
Astonishing.
Yeah.
Right. So, the idea that, this should be federally regulated because the federal government does such a better job at solvency regulation. I mean, that you can dismiss that
bit of a non sequitur
fairly quickly.
Yeah. But he didn't. Was it just because he was biased, being a federal politician?
I think there is. I spent 4 years in Washington when I was CEO of the NAIC.
Yeah.
And I remember having a conversation with someone at one point who was in the federal bureaucracy and was trying to figure out what to put in Dodd-Frank to address a certain issue. Mm-hmm. And I said to him, why don't you just not deal with that issue and let the states deal with it?
Okay, yep.
Because there are believe it or not,
there
are smart people in the states too.
Yep.
And
how did he or she react?
It was a little bit of I can't do that because what if they don't get it right? But there was, I found that over and over again. There was an attitude of we're really smart people. We are going to divine the right answer and then impose it on everyone. Yes. And it was extremely frustrating to me. Yes. Extremely frustrating. So I forgot where we were, what we were talking about.
We were talking about the Dingle reports. And
the Dingle report, okay. So there's this culture in Washington.
But let me actually keep on the culture in Washington for a second. So there's another book, I've forgotten the name of the author. It's called The Best and the Brightest. And it was about the Vietnam War and how it was a similar idea where you have people who are the superstars, right? It's like the astronaut kind of thing, right? The best and the brightest going into the federal government, and they're going to make these decisions, which are amazing because they're so smart.
Because they're so smart,
and they know, and then their IQs are like this, and they went to Harvard and blah blah blah, and they're going to make all these great decisions, and then they go wander into the Vietnam War, which is just disaster, right? And it's like, well, thanks for that. And it's not just about being smart. It's about the knowledge of local knowledge, for example, and lots of smart. We're all pretty smart guys, kind of thing, quote unquote. And it seems to me that that's an inherent feature of Washington, an inherent feature of anybody who's distant and smart, who thinks I know more than you because I don't know you, so I'm going to assume the worst of you, and then I know that I've done so many good things with look at my resume. Let me just figure it out. Mm-hmm. I can figure things out.
Mm-hmm.
It's hard to talk them out of it because you can't really dispute the premise in some ways, right? You can't say no, you're not smart because they are.
No, they are smart. Yeah, they are smart. But this is why I said there are smart people in the states too. Mm-hmm. Don't tie their hands. Let them think it through. And my experience with Washington is that too often it was about hand tying. And the more we can get, now I'm showing my political kind of perspective, the more that we can free the states from tying the hands from Washington tying their hands, the better we're going to be.
Yeah, this mix of political philosophies that underlies state regulation, advocacy for state regulation, just absolutely, I find it so interesting because so much of, and I made this point at the beginning of this conversation, so much of the ideas are typically considered very right-wing ideas. Right, the idea of states' rights, the idea of devolution of power, of let them figure it out, of of kind of quasi-libertarian ideals. I mean, these are not things that the people in the libertarian, call it political, I don't know, philosophy, think they're going to hear from a regulator, right? And you've written papers with the Cato Institute, right? This sort of right-wing think tank, and I mean, do you get frustrated when you? I mean, you probably are aware of this bias, and you're probably aware that like it's not that simple, guys.
Yeah. It's not that simple, guys. Yeah, I am. I am. I'll tell you where it came up a lot was in the international arena.
Interesting.
What I found was that there are jurisdictions, particularly in mainland Europe, which are very focused on getting the rules right.
Yep.
And I would find that frustrating
Yep.
because I think you have to get the processes right. And there was not as much focus on process as on rules. And I came back, when I first came back to Drake, I was talking to one of our international business professors, and I said, just don't get the Europeans were so rules focused. I mean, some of the stuff that they would come out with in Conframe was so prescriptive. And I remember my colleague saying, you can thank Napoleon for that. And I thought, now that's interesting. That's interesting because it does speak to a different history and a different culture and a different way of thinking
different legal
about,
system
and a different
rules,
way
you
of
know,
thinking about
right?
problems. And so yeah.
So I would like to make sure we get into the financial crisis because that was such an interesting episode in history. And I mean, and you were right in the middle of it in Washington during that time. Tell me about maybe the moment when you realized this is big. Something big's going on here.
Well, I was teaching in the spring
Of 2008.
2008. I was teaching a graduate course on the regulation of financial institutions. And we had gone through all of this stuff on moral hazard and market discipline and systemic risk and too big to fail.
Yeah.
Because it you know, that you can't talk about regulation of financial institutions without going through some of this history. And it was a subject of great discussion following the savings and loan crisis.
Yep.
And the, you know, and
all kinds of bailouts. There's
all
the
kinds of
Mexican
bailouts,
peso
right.
crisis. There's long-term capital management. On and on the list goes.
Exactly. So we spent, you know, a little bit of time kind of reading things and talking about those things. And then Bear Stearns happened. And I remember going into class the next day, and we talked about Bear Stearns, and we talked about the implications of market. And I remember thinking, this is not over. This is, you know, the canary in the coal mine kind of thing. But of course, it was the weekend of the Lehman AIG thing that really.
Is that when you had joined the NAIC through that
No,
summer?
I had not. So I had been approached by the NAIC in the summer. The previous CEO had resigned, and they were searching for a new CEO.
For some reason related to this, or
No, just she'd been there for quite a while, and I think was ready to move on. And so I had gotten called, and I was on some boards. I was teaching at Drake. I was liking where I was, and so I said no. And then I spent the fall, and never forget, I spent the fall because I was thinking, this could be like the 30s.
Yeah.
And so I started going back and reading old journals from 1931, 32, 33. I Googled the name of the superintendent of insurance in the New York Times in 1932 and read everything I could see where he was quoted. I went and read NAIC proceedings from those periods, just kind of trying to get a feel for what was going on.
What was going on back then? Because that was a different kind of tumult going on. It was in that individual.
I'll tell you, one of the most fascinating things I saw, and I did write a paper about this too, was the debate over fair value accounting versus something more akin to amortized cost.
Yeah.
It was a fierce debate,
Yeah.
and the language that was used was identical to the language that was used during the financial crisis.
Yeah.
You know, the
liquidity
market
problem or a solvency problem?
Yes,
Yeah.
right,
Yeah.
right. And so that was really interesting. But so I was reading this stuff, and I was and in the fall of 2008, age, I was teaching a course on the management of financial institutions to undergraduates. And so when the Lehman AIG thing happened, we kind of threw our syllabus out and spent the semester on, did a little
a teaching
bit
moment.
A teaching moment. Did a little bit, changed things around a little bit. That was just a blast. But then we got to, and I think it was the week before Thanksgiving, and I was at a board meeting in Bermuda, and stocks fell off a cliff.
Yep.
They just went, like the life insurance company stocks in particular, just fell off a cliff. And there was incredible dislocation. And one of the board members, I remember saying, there's nothing trading. He was an investment banker type person. He said, there's nothing trading in the market. There's nothing. I don't mean there's not much trading. There is nothing trading. You can't sell anything.
Wow.
And it was a very frightening, frightening time. And I got on the plane in Bermuda, and I flew to Atlanta. I was thinking the whole time, this is going to be historic, this is going to be historic. And landed in Atlanta and sent an email to one of the commissioners and said, if the job's still open, I want it. And that was it.
Gives an opportunity to be
in the middle
of it.
in the middle of things while they were happening.
Yeah. And so let's go back to that comment from the investment banker, because there now we have a situation which was those same bankers were going to Washington and saying, there's nothing trading. This is the biggest catastrophe to ever happen upon the financial markets. We must do something now.
Yes.
Right?
Yeah.
And that's access to them and information flowing into them. How did it feel to you hearing that? Did you do you sympathize a bit more with the people in Washington hearing that?
Oh, absolutely. Yeah. Absolutely. I mean, I think it was a scary time. Yeah. It was a very scary time. So I do.
Do you feel like they did the right decisions? I mean, these bailouts and all that. I mean, would you have thought so beforehand?
There is. You never know what would have happened.
True. Counterfactual.
Counterfactual.
Yeah.
You never know what would have happened if Bear Stearns had been dealt with differently.
Yeah.
You'll never know. Yeah. And I remember someone saying to me, Bear Stearns was the 5th largest investment bank in this country. If it couldn't fail, come on. It was there. So
yeah. Who cares?
So I don't know. But but look I don't know all the details about what was going on at Bear Stearns. I don't know. It's tough to make decisions in a time of crisis.
Yeah.
And so I'm gonna, give my sympathy to those people, but I can't help but wonder what the alternative might have been. Mm-hmm. You don't know. You'll never know.
Mm-hmm. And so back to my initial contact with you intellectually was reading this paper of yours where you made the point that, rightly, saying that insurance companies came through the crisis pretty well, right? Yeah. With the exception of financial guarantee insurance companies.
Right.
And so financial guarantee companies are an interesting case because...
And some people would say AIG. People would point to AIG.
Yep, okay. Right. So when you talk a bit about AIG and financial guarantee insurance companies, as they reflect on the performance of the insurance industry, they all kind of went bust, but not really for insurance reasons or not for P&C insurance reasons, right?
Yeah.
Were you familiar with them at the time?
Well, so the AIG, I know you know the story of AIG, which was this credit default swap business, which was outside the insurance companies. Now, there were some issues related to securities lending as well, but the big problem were these credit default swaps. And when the bailout of AIG happened, it was essentially... I would frame it as it was a bailout of the banks. I mean, the money went in the front door at AIG.
Yeah. AIG didn't get any of that money.
It went out the back door to European banks and U.S. banks.
Yeah. It was a bailout of Goldman Sachs.
Well, but it wasn't just a bailout of Goldman Sachs. It was a bailout of European banks.
Yeah.
And I find that interesting because there's no way that the Federal Reserve could have directly bailed out those European banks.
Yeah, right.
But they could through the AIG bailout.
Yeah. Did they know that at the time, do you think?
Absolutely.
Right.
Absolutely.
This is what we're really doing here.
Absolutely. I know for a fact that they did.
Huh. So why do they do that? Because it doesn't matter if too many banks go down. It kind of doesn't matter where they are. If they're all interlinked, then that means all the banks over here will go down. I think the
connectivity in that. I think
Pulling
the
up
other
too many
part.
blocks in the Jenga tower.
I think the other part is that these linkages. It wasn't as simple as just unwinding all these linkages. They were complex, and they were at one point the banks had a big problem with just even getting the paper processed in time. So there were back rooms that with backlogs of trading slips that hadn't been processed, and so
why was that?
I think
It's just too much.
It's just a lot of stuff going on. So. So anyway, I think it was the unknown about how it would play out.
So AIG is a pretty special case, and the financial guarantee companies not bailed out, went bust, right?
Mm-hmm. When it got resolved.
Yeah, no big deal. So is that evidence for it not being as bad as it looks? Or how strong of evidence is it?
I would say, given the magnitude and the horrific problems that these financial markets faced, the industry did pretty well.
Yeah.
And not only that, but the industry, as I've often said, was a source of stability. Mm-hmm. The industry was the first one to come back into the market and start buying up these undervalued securities.
Yeah.
The industry was not dumping securities the way some other financial institutions were. So they kind of held there. And granted, it was rocky. I'm not saying we didn't worry. We did worry. We were watching these companies closely. We put together a special team to do deeper analysis. But we were waiting. We thought, okay, if a big you may remember Hartford had the first quarter of 2009 was really
bad.
Was really we were watching the S&P every day.
Yeah,
what's the S&P? Crashing. What is it? And then the big question is, what is it going to be on March 30th?
Yeah.
What's it going to be?
Yeah, sure.
And but at the end of the day, there were only two companies that took the kind of TARP funding that the banks took, and that was Lincoln National and Hartford. And that, they had to go out, I love this, they had to jump through these hoops, go out and buy these dinky little thrifts in order to become federally regulated so they could get the TARP money.
Well,
which was a good thing. I mean, that was
right, because
to make them go through another hoop.
Yeah. As opposed to saying, okay, well, let's make them all federally regulated as potentially an alternative.
Right.
So how did you find that? How do you find Washington, if I can use that kind of blanket noun, respond or react to the fact that the insurance industry did okay? Were there lessons that other folks might have taken from that, saying maybe there's something different about the way this is, or did it give them pause, you think?
No. No, I don't think so. I think there's still a well, I think actually I take that back. I think it depends on who you talk to. So there are probably different views, but there are some in Washington who would say that the insurance industry benefited from all of these other things that the federal government did, and had that not happened, the life insurance industry would have been in big trouble.
Okay.
And the life industry was out there during the height of the financial crisis. In fairness, they were all knocking on the door of Treasury saying, we want access to TARP. At the end of the day then, when you had to jump through these hoops, there were only two that did it, but they were in there saying, we want access to TARP. Or, going to the Federal Reserve and saying, will you give us a liquidity backstop if there's a run on, if people are worried about the guarantee funds, can we get a liquidity, borrow from the Federal Reserve for the guarantee funds? And the Fed said, no, you're not federally regulated. We can't do that. Or so I heard. Let me say, I heard this.
Yeah.
But so those activities suggested that the industry was really concerned, and as I said, we were all concerned. But then the other thing that they will point to is AIG.
Yeah.
So
yeah,
it's hard. It's hard to
fight back against
explain away the AIG.
Yeah. One of the interesting observations that you've made in in discussing the trade-offs between state and federal regulation is, and I think you mentioned this earlier in this conversation, is the nice thing about states is that they don't actually have the money to bail out all these companies, right? Travelers being based in Connecticut, maybe,
Yeah.
right, or Illinois. That state doesn't have enough cash to bail out Travelers. It just can't be done, right? And so that's actually a good thing in this conception, in kind of the libertarian conception of this, because the resources, starve the beast kind of thing, right? You don't have the resources to make these decisions, which you kind of want to do in the minute, but are actually bad in the longer term. That, to me, is interesting in a few ways. One, because it's surprising to hear that argument from a regulator, but it's also interesting because it actually seems to me to be a disempowering of the... So think about it this way. So regulators, what do? What do regulators do? They have rules, they enforce the rules, right? That's one kind of simple way of thinking about it. The Europeans would certainly agree with that. And if you're going to enforce the rules, you need to have kind of resources to enforce the rules. And so by that logic, right, again, this sort of libertarian idea where every law is backed by the military power of the U.S. government, right? So if you break the law, ultimately there's a long chain of events which might end in more or less them taking you by force and making you do something that you broke the law and so didn't want to do. But it seems to me it's interesting that there are a limiting feature of power that gets plugged into here. It seems to me something that is almost, contrary to the philosophy of really every single thing a government says you should do is ultimately backed by extraordinary and unlimited force, right? And you're saying actually unlimited force is not actually a good thing. In this case, with regards to financial regulation, we want to limit our ability to act in some ways because that actually leads eventually to better outcomes. Is this making sense? This sort of...
I understand exactly what you're saying. And here's what it is. What is the balance between regulating the activity and allowing room for innovation? Okay? And there's a balance there. There's a balance. And I think that the way that the U.S. regulators strike that balance is by having a regulatory system, a system of rules that leaves sufficient room that the insurers can play within that field. And then a key part, what you didn't mention, you talked about enforcing the rules. I would say the monitoring of what's going on so the regulator knows when to step in is as important, because there's room for companies to maneuver, and you want to leave that room because markets are dynamic. But then you have to know what's going on, and you have to step in a timely manner so that consumers don't get hurt. And that I guess that would be my answer to you, is you have to find this balance. It's not just about here are the rules and we're going to enforce these rules and you're going to stick to this.
Yeah.
It's about here's the field in which you're allowed to operate.
The other thing one thing that amazes me about insurance is actually how interlinked it is between. There's all these different institutions, be they call your policyholders, you'll have stockholders,
Right.
you'll have regulators, you have rating agencies. We haven't talked about rating agencies. Interested to hear what you think about them and other institutions. And you have reinsurers, right? Everybody's kind of watching each other all the time.
Which is great.
Yeah.
Which is awesome.
Yeah,
which
so
is
many legs
awesome.
on the stool.
Which is why, that is part of what makes this industry function well. When you cannot, given the diversity of the risk that this industry takes on and what it is asked to do, you can't micromanage the industry.
Yeah.
And so you need to have...
complicated.
You just can't do it. You can't do it. And so you need a structure where there are a lot of pieces to how this industry is disciplined.
Yeah.
And the reinsurers do that, and the rating agencies do that, the agents and brokers do that. And the regulators do that.
I mean, you can, again, sympathize in some ways in an intellectual way to have a federal regulator look at that and say, there's a lot of cooks in that kitchen. Is it all really necessary?
Yeah, I think it's a healthy way to do it. I mean, we used to, I remember when I was insurance commissioner, and if there was a company in the marketplace who was doing something erratic, irrational, pricing was just way below what anybody else was doing, we'd get a call from an agent telling us, you need to watch out for that company.
Incredible.
You need to get in and take a look at that company. So that kind of thing, everybody kind of watching and working together and caring about the solvency of the industry.
Yes.
That's a powerful thing.
Yeah, and I've I'm at a reinsurance broker, but we were bought by an insurance broking entity recently, and gotten to know insurance agents, and it is amazing to me the degree to which people are really aware of actually, how bad it is when a company goes out of business, and how hard it is for that to get figured out early enough, really to act. Act in a way that's gonna be useful for everybody. Let's talk about rating agencies for a second. There's a few of them. Should there be more? I mean, it's interesting that there tend to be kind of in that segment a bit of a monopoly, maybe in the United States with AM Best. What do you? How does the regulator look at that rating agency? Because they are the one that overlap probably the most with what regulators do.
I think it's great. I think the rating agencies that are in there telling the companies you need to raise your capital, and the companies are going, I'm all for it.
Yeah.
I think it's a healthy dynamic.
Mm-hmm.
So.
And reinsurers?
And reinsurers play a really powerful role in, regulating, regulating the industry.
Yeah.
And so, yeah.
And what about a world in which you say, and this is actually kind of comes to an idea which manifests itself in, let's say, Germany or Japan or I think South Korea, where all these companies all have stock holding in each other, right? Yeah. And so you can imagine a world where a regulator would say, you know what? All we're going to do is just force everybody to write each other's quota share reinsurance, and have the entities just have there'd be a much more, a version of called solvency regulation would be to just have more people making money off of regulating a company by taking a part of the result. Mm-hmm. Would that work, you think? Is that something that people think about?
I don't know. I'd have to think about that one. I don't know. I don't know.
What do reinsurers miss that regulators care about?
What do reinsurers miss that? I think regulators probably pay more attention to how consumers are actually treated in the marketplace.
Okay. Yep.
How quickly are claims paid, and what happens to policyholder complaints from a market conduct perspective. What kind of advertising is the company using? I think regulators probably pay more attention to that stuff.
Consumer protection stuff.
Yeah.
So maybe we can talk a bit about regulators. What's it like working at a regulator? There's this perception that it's hard to hire quality talent at regulators because you can make more money in industry. Is that true, do you think? What's it like running such an institution, and how and in what way do you look for talent? And
so it is true. Compensation is an issue.
Yeah.
When I became insurance commissioner, I took a 2-year leave of absence from Drake, and it turned into 10.5 years, and that was because the issues were so fascinating. I just loved every day. It was something new. It was, you're on the front line of what's happening in the industry. They coming to you with some new idea. Companies are coming to you all the time with some new idea. So it was fascinating. So what worked for me in attracting people was to try to say, look, just come do this for a little while. And, we can't pay the most, but you're going to get all kinds of experiences. And I think regulators try to use that. I think it does work. But it's tough. It's tough to get, you can't pay the salaries that, the private sector can pay often. And so human capital in these regulatory agencies is a big challenge.
Is it a different kind of person, too, in some ways, that would work in industry, or is it the same skill set, same different personality qualities?
What I always look for is somebody who is curious, who wanted to learn. That's always been, and I think businesses probably. That's also something that they're interested in, is curious and wanting to learn new things. Yeah.
So we're almost out of time here, and I'd like to close. I'd like to come back to the financial crisis. It's 10 years ago now. It's 2018. I'm wondering, reflecting back on that, if there's anything that went on then that you feel like you could have done differently, or yourself, or what sort of, is there a deep lesson there that wasn't obvious at the time that, looking back now, you think about sometimes?
That's a great question. Because that's a great question. What could we have done? That's a great question. We were trying to do so many things.
Yeah.
And probably, I guess I spent a lot of time trying to figure out how these states and the NAIC fit together and how that was going to evolve over time in a way that kept this, when I said this diversity of thought, diversity of perspective in the states is really, really important. And when states have budget issues, how do you make sure that you have that human capital at the state level so that you can maintain that diversity of thought? And I think we could have spent a little more time on that, a little more. The states were having real bad budget issues, and we used to talk about trying to partner with, the National Conference of State Legislatures and NCOIL and the Governors Association to try to help them understand better the challenges that the regulators are facing, and I don't think we made much progress on that.
And you mentioned earlier that you made an allusion to how the NAIC may be growing in importance, and that I suppose, relatively speaking, means the states are receding in importance. And you made a few comments here.
Well, here's what I think is happening, and there's a tendency when something new is created. For example, we have principles-based reserving on the life insurance side. And so you need to have expertise at the state level on principles-based reserving. How do you look at these, filings that the companies are making? How are we going to have the regulatory expertise in this new model of reserving? And the tendency is to say, well, let's create expertise at the NAIC, and that expertise will then educate the
like
states.
The federal government.
Exactly.
Yeah.
Exactly.
Yeah.
And then that will educate the states. And while you still have a system where the states are, independently responsible, and they have influences from their local marketplace. So they're going to take this and learn from it differently. But it does create a different structure. It's not just the NAIC staff there to facilitate this exchange of information among the states. It's the NAIC staff driving how the states look at things.
Yeah.
And that, I think, is something that we need to be real careful about how we do that.
My guest today is Terri Vaughan. Terri, thank you very much for joining me.
My pleasure. Thank you.